on my main screen, and we're delighted to have you here. So we're going straight from Tel Aviv via London and now to New Jersey and New York. And so Bob Burke began his 36 years career, I think, in the mid 80s. And I think you've always been involved one way or another with domestic credit markets, so very much US corporate fixed income. And I think in the first 20 years of your career, you held various investment banking jobs, including trading, sales, and leverage finance. And I think your last sell-side job before you moved into asset management, I think your last sell-side job, you held a very senior position at Lehman Brothers, where you were global head of high yield at Lehman, worldwide, including leverage loans. And that was before the great financial crisis. And then you chose, before the great financial crisis, you chose to start your own company and move on the investment side of the business. And your company is called Par 4 Investment Management. Very nice name, by the way. And I think it was founded in 2003. And you focus basically on that small segment of the market, which is, alternative credit, for lack of a better term. And you focus on, of course, on US credit markets, extracting, value, I guess, from that market for yourself and for your clients. And I think, amongst the various sub asset classes that you focus on, apart from, plain vanilla high yield, I think, there are SMAs, CLOs, and various, vehicles, to use a French word. And so, I've given a broad brush intro, but why don't you tell us a little more about what you do, Bob?
Sure. So we started Par 4 in 2003, and after a pretty long career on the sell side, and at Lehman Brothers, as you said, I ran the high yield leverage loan and distressed sales globally, and I always wanted to really start my own credit business. So we started in 2003, and we've run a number of hedge funds and distressed credit product. We have a CLO business. We've done some SMAs as well, and really the opportunity set, quite frankly, right now has never been better on the distress side, and I'm pretty excited about it. So that's something I hope we can talk about today.
Right. And so currently, right now, if you were to tell us, what is the biggest difference you see in this credit, the current distressed cycle, compared to perhaps in 2009, before the great financial crisis? Because, people are saying that the crisis is coming, and certainly if you look at GDP figures, our national economies seem to be collapsing, and yet, very strangely, within that huge COVID-19 crisis, we haven't seen yet these bankruptcies. So tell us, as an expert in that field, what is your view of the current situation in the US compared to the previous credit cycle in 2009 and 2010?
Sure. Well, that's a pretty loaded question. So let me tackle first where we are now and what's anticipated. So, if you think about, there was a capitulation trade, which was in end of March. I think it was March 23rd, where you had quite a bit of selling, really across the board in every asset class, but particularly in leveraged loans and high yield in a pretty severe way. That was more of a technical sell-off rather than a fundamental sell-off. And I would say, people have asked me, gee, did I miss the trade? Or is it still coming? And the answer is it's both, right? So yeah, the technical sell-off has come and gone, and the markets rebounded across the board, frankly, in higher quality paper, primarily due to all the money supply being thrown at the markets from both the Fed and the Treasury. Conversely, though, the fundamental trade is still going to transpire. So on a trailing 12-month basis right now, we're running at about a 4% default rate. Many of those credits that have defaulted heretofore, they were gonna file anyway. Those are not good companies with bad balance sheets, and frankly, these aren't the kind of companies we go after anyway. So if you think about a lot of the energy companies and some of the distressed retailers like J. Crew and the like, those were apt to file bankruptcy in any case. What's going to transpire is a lot of good companies with bad balance sheets that are going to file bankruptcy over the next probably 2 years or so, piecemeal. And we thought that even before COVID. And really what drives that is leverage in the system and weakness in the structures. So as I said, we're at a 4% default rate now. If you talk to any of the strategists on the street domestically, depending on who you speak to, they're predicting anywhere from an 8.5% default rate to 12.5% default rate over the next 12 months. And and fans of Jeff Gudlick at DoubleLine, he thinks we're going to more than double by year end. I think people that believe in Professor Edward Altman, he's saying the same thing. We're going to double before year end. So it's pretty much in agreement across the board that we're going to have a surge in the default rate. And that's really predicated on just being at the end of the cycle. So if you think about how these cycles work, the private equity sponsors put more and more leverage on these companies in order to get the highest MOIC possible. And every year where you have a benign default rate, the sponsors get more and more aggressive and continue to add leverage in the system. This is the highest I've ever seen leverage in private companies ever. So if you look at where we were at the end of first quarter, on average, you saw leverage just through the first lien loan at 7 times. And that was at the end of the first quarter. And there was only, 2 weeks of COVID in the first quarter. So then you think about, okay, all these highly levered companies had to draw down their revolvers for the most part to fund their cash burn during Q2 while they were shut down. So of course the debt burden has skyrocketed, and moreover, the second quarter numbers were pretty horrendous. So if you look at a trailing 12-month default rate after Q2, it was really astronomical. So there's a lot of companies that are sitting there weighing their options, and they're saying, okay, my leverage has never been higher. It's going to take me a long time to get out from under that debt burden. What is the alternative, and what does bankruptcy afford me in the form of benefits? So there are plenty, certainly, in addition to deleveraging your balance sheet. And therefore being more competitive against your rivals. You also have a lot of incremental benefits. You can renegotiate your leases. You can rip up unprofitable contracts. You can lay off employees and shed non-core assets. And then from a selfish standpoint, what a lot of the C-suite guys look at, and I've seen this every distress cycle, they look at the MIP that they have, the equity that they've been awarded from the private equity sponsor at the time of the transaction that was pretty robust, and everybody was excited, and they were very loyal to that private equity sponsor. And then what happens when a company starts to falter and get more leverage and have struggles, all of a sudden they see the value of that MIP diminish fairly significantly. And in this particular case, with so much leverage now in a lot of these companies, particularly after the second quarter, they're looking at the value of their equity as zero. And so what typically happens is a number of distressed investors cozy up to the management teams and buy a lot of the debt deep discounts and offer to award the management team on a post-reorg basis a pretty significant chunk of that equity. So, as much as 10% in the form of a MIP on a delevered credit. All of a sudden, that loyalty shifts pretty dramatically from the existing private equity sponsor to the distressed manager. And then post-reorg, that management team gets a pretty healthy reward in the form of a new MIP. So, I'm pretty confident based on where we are in the cycle, based on my conversations with a number of bankruptcy attorneys and private equity sponsors and restructuring advisory firms, that there's a lot of credits that are going to file preemptively, even though they can meet their debt service requirements with these de minimis interest payments. So we expect a pretty big surge over the next 2 years. Again, piecemeal, but in talking to all these professionals, it's really across every sector. So, I get asked a lot, is this just, hospitality and airlines and energy? And the answer is no. It's really across every sector, and thereby, offering huge opportunities.
Right. Because of course, the reason why the market recovered following that end of March 2020 collapse is, of course, the unusual, even by today's standards, monetary complacency. So central bankers the world over have printed money massively in the past 6-7 months, and perhaps they didn't have the choice. And at the same time, governments, federal governments, have been throwing a lot of money at the problem, hoping that things would improve later on. And of course, they can't keep on throwing that much money forever. So there will come a time when they will unplug. And so that perhaps there is that sort of pent up, as you alluded to earlier, pent up distress. We don't see the distress signals, or we don't see the bankruptcies every day on the market, but there is that pent up weakness waiting to happen, right? And you think it's really not only 2 or 3 sectors, it's really much broader, right?
That's right. Yeah, it's going to be across all sectors. Certainly, hospitality and energy are going to take a big chunk of it. But in looking across, where there's been so much leverage, it's really across every sector. It's not just isolated to direct COVID-related credits. Right. You asked in your last question to compare and contrast this to the last cycle. So let me just tackle that if you don't mind, because there are dramatic differences, and it makes this cycle the most attractive I've seen in my 36 years of doing this, right? And so there's really 3 major points, 3 major differences in my view. The absolute size of the high yield leverage loan market is almost 2.5 times what it was in 2008. So right now we're at $2.6 trillion in total size of high yield and leverage loan combined. That's approximately 50-50, and that's versus 1.1 trillion back in 2008. So the absolute size of the market is pretty dramatic. We had a 13% default rate back in 2009. If you believe these guys, as I said before, anywhere from 8.5 to 12.5% default rate. So, pick a 10.5% default rate. You can see there's more than double the opportunity set, even with a lower default rate, and opportunities to choose from. So that's the first thing. The second thing is the fulcrum security, and I'll get to that in a second. And the third point I'm going to touch on is the exit strategy, because exiting and making your money on a distressed investment includes not just buying it, being able to monetize your gains. So let's focus on the fulcrum security for a second, because that's extraordinarily important, and it's really different this time around. So for all those who don't know what the fulcrum security is, it's part of the capital stack that you procure when you're a distressed investor in order to essentially create the equity at an enterprise value multiple of EBITDA less than its peers. In this particular instance, in this cycle, the fulcrum security more often than not is first lien bank debt, which really has never happened before. Typically, it's always been unsecured debt. And it being the fulcrum security being the first lien bank debt offers a tremendous amount of benefits. Number one, you can get out of bankruptcy sooner, which is a real benefit. Number two, you have less restructuring advisory fees and less lawyers to pay, because there's only one creditor class for the most part. And sometimes that can be pretty significant. Third, you get adequate protection payments, meaning you get paid current in bankruptcy. So either you get your interest during bankruptcy, or you get it as a post-petition claim. But unlike unsecured creditors, you don't get that. And fourth, and most important, you have this fantastic asymmetric risk reward. Now, what I mean by that is you have a floor and you also have almost unlimited upside. So let me explain what I mean by that. So typically, if you were in previous cycles, if you were investing in an unsecured class, you could be technically crammed down by the creditor class above you, which means you could get impaired. So it was more of a binary bet. You have a tremendous amount of upside because you got the equity, but if there was a valuation fight or things changed in the bankruptcy or you got a more friendly judge, et cetera, you could get crammed down and get severely impaired as an unsecured creditor. Conversely, if you're at the top of the capital stack, you can't get crammed down by anybody, really. And Section 1129 of the U.S. Bankruptcy Code and the absolute priority rule basically make sure that the first lien gets paid par plus pre-petition and post-petition interest before anybody gets anything. You have to get what's called the indubitable equivalent of par. So you could get exit financing and cash or what have you. But if you were to get equity, irrespective of the value of that equity, you're deemed to be impaired, which means you get to cram down people below you. As far as more upside, hence the asymmetric risk reward benefit, you don't have anybody to cram you up. Typically in a bankruptcy where there was unsecured debt, the unsecured debt could cram you up, meaning they could take you out at par and then you don't get a vote on the plan. So you were capped typically at par plus your pre-petition and post-petition interest. Now, because so many of these credits are only first lien in the capital stack, there's no one to cram you up. So if you take the keys, if you get the equity, you could get far more than the notional value of your claim.
And when you say getting far more, implicitly, do you have like 18 months, 2 years? What is your implicit horizon?
Typically, shortly thereafter bankruptcy, within 6 months to a year.
To a year.
Or even less. I mean, you could actually get equity that day one is worth more than par, arguably. And so it's really interesting. Only 5% of credits pre-crisis were loan-only structures. Now 35% are loan-only. And then if you say, okay, are first lien only. And then if you say, okay, what about first lien, second lien? 63% of the market is first lien, second lien, with no unsecured debt below you. And what's interesting about that is most of those second liens are silent, which makes the first lien the fulcrum anyway. So as far as the opportunity set, who doesn't love asymmetric risk reward? It's fantastic, right? And when you say how quickly can you realize that value, so what happens is you buy this deeply discounted debt and you create this post-reorg equity at a significant discount to its peers as measured by enterprise value multiple of EBITDA. Then during bankruptcy, you renegotiate contracts, you rip up some leases, you shed your non-core assets, you get rid of employees you don't want and have the PBGC pick that up, et cetera. And now you emerge and immediately you're no longer at trough EBITDA, you're not certainly at peak EBITDA, but you're somewhere in the middle. And so that equity realizes value right away. And again, in my 36 years of doing this, I've never seen such huge opportunity to have asymmetric risk reward where you have a floor to your investment and you have upside well in excess of par.
Right. Got you.
On that third bullet point, though, and let me just touch on this real quick, the exit strategy is paramount, right? Because you have to have an exit strategy before you put an investment on. I think the mistake so many managers make is they get all excited about procuring a really attractive asset, but they don't have a plan on how to monetize it. So oftentimes, distressed guys will monetize the asset by going public, but then it trades sloppy in the public market until such time as equity analysts start to write up those and publish those assets. And it takes about a year to show value. Conversely, this exit strategy is the most robust I've ever seen in that there's all these private equity sponsors that have raised a tremendous amount of money. Most of that is unspent capital, and it's use it or lose it capital. So typically what we do is we hire an investment bank post reorg, and we have them auction the company. And we believe with all this money on the sidelines, there's going to be a tremendous demand from the LBO sponsors to procure these assets pretty quickly, and they'll be getting a great deal because they're going to buy these companies at a really cheap multiple.
So the asymmetry, from your experience, the asymmetry is really unique and exceptional compared to previous cycles, right?
That's right.
That's the main factor. Okay, and so that's fairly interesting because of the risk-return profile, the relative risk-return profile compared to other assets. And now, on the flip side, I know it's only the beginning of that journey now in the U.S., but on the flip side, what keeps you awake at night? So what is the biggest risk, or the single most biggest risk, in your opinion, in someone, a pension fund or sovereign fund or endowment, putting money into distressed debt in the U.S. now?
Well, the biggest change I've seen, and that's basically on structure and covenants. They've never been weaker. Covenants have never been looser, and that's really frightening. So it's like driving as fast as you can on the highway with no guardrails, and they took out the seatbelts and the airbags, right? So really, you have to focus as a manager. You have to focus on not just bottom-up fundamental credit analysis, but more so even on structure and covenants. So what is structure? Is there a restricted group or not? Are there subsidiary guarantees or not? Is there any intercreditor loans? If there's holdco, opco, is there a J-Crew blocker, which prevents, especially on the secured side, companies from stripping out collateral? What's the strength or weakness of the intercreditor agreement, which is a subordination agreement between first and second lien? There's a plethora of extraordinarily important structural nuances. And then the covenants, as I said, maintenance covenants left a long time ago, but even the negative covenants are so weak now. It's really a minefield out there. So if I would just say, if any of the pension funds are interviewing managers, you make sure you get one that really understands and appreciates and focuses on structure more so than anything else, because you can get severely hurt. I've never seen the sponsors really exploit and take advantage of creditors in such a way that they have. You might read this language and think you have these protections that you really don't by the way that lawyers have crafted it. But I've also never seen so much creditor infighting, even in the same creditor class. Now, the U.S. Bankruptcy Code says you're not allowed to have disparate treatment if you hold the same class. But I've seen it now. There's ways of guys being able to try to take advantage of other guys by doing all these medieval things. And so I would just say it's paramount that a manager really focuses on structure and covenants more so than really ever in the past, because they're so weak at this point.
Thank you, Bob. It was very enlightening. And as I said to the earlier speakers, we really look forward to, once the COVID crisis has passed, to see you in the flesh in Paris. And without further ado, from New Jersey and Wall Street to Mexico City, your neighbor south of the border,